Welcome back. Rajesh Bhatia is now with us of ITI. Rajesh, great to have you with us here. Thank you for your time and good to speak with you as always. Just a quick word, Rajesh, on the Axis story, numbers, and will viewers who are watching, and I mean, the view generally is, I mean, from here, perhaps you will make money buying the name. I mean, that seems to be the general overall view, even though the stock is down about 5%. What is your sense here?
So not that I can comment on specific stocks, but I think the disillusionment with some of the private sector banks, including the one which you talk about, is that the NPAs have come up in spite of very low growth in loan. So it's not as if your loan growth was galloping and you make mistakes. Those are kind of acceptable. But I think with slow loan growth, you still have a credit cost which is kind of elevated and different from what other private banks are kind of registering. As you point out, there's still optimism, and I think that's based on two factors. One is that basically the valuations still are quite low compared to, for a private sector bank, relative to the other large private sector banks. And the second is the ingredients. I think the ability to make an ROE like other private banks are there. Just that there is an issue of this credit cost which keeps coming up, because of which I think there is some disillusionment in the short term. Having said that, I think it was fairly expected that most banks will see pressure in the first half because of the interest cost decline, which is impacting their NIMs and a low credit growth. We all know growth in the system has been very weak. We are in a slowed economy. And to be expected that second half onwards is when the NIMs will kind of bounce back for banks. So it's all expected as far as credit growth and NIM is concerned. In this particular case, there has also been disappointment as to the credit cost.
Rajesh, I mean, any trend that you spotted from the IT numbers so far? We've got 4 out of the 5 large cap IT companies reporting their numbers. And are you getting a sense that, margins could be the next big thing to get hit? Growth was already hit over the last 2 years, but now margins are increasingly looking weak. HCL Tech lowered its guidance by 100 basis points. Companies are deferring their wage hikes. No one yet has announced a wage hike for FY26. They're all saying we're going to take a call based on the macros. So clearly there is some sort of margin pressure. Maybe it's AI-led deflation, or it just could be slower, a weaker top line. But first, any trend? And to your thoughts on if margins could be weak for IT going forward.
Yeah, so I think as far as large cap IT is concerned, I think we are gravitating towards a low growth environment. Of course, the US economy is doing quite well. So I don't think there are any challenges there. Nobody is really talking about a recession in America. But decision making for IT companies is getting deferred. And one of the common reasons which we hear from IT companies is that this uncertainty regarding tariffs. Once there is greater clarity on tariffs, a lot of decision making as far as spends will actually accelerate as we move forward. Even on AI, I think what we are hearing from these companies is that while there is deflation as far as AI is concerned, it's not as if the dollar budgets are getting squeezed. The dollar savings are translating to other spends. And therefore, it's not as if the dollar revenue growth will kind of decline because of the deflation in AI. Having said that, the growth will probably accelerate once there's greater certainty on tariffs. Second is look at how these companies have already deflated as far as valuation is concerned. I mean, the top tier IT company is probably at 4% dividend yield and 21 times earnings. It used to be 30 plus times earnings. So there has already been a good deflation in the valuation. Now, these are still going to be marginal growth companies. And therefore, the dividend will not accelerate to 7 or 8%. Let's say like a coal company does, or a lube oil company, where there was very little growth expectation. These are still companies which will grow and have massive free cash flows. So to that extent, 4% dividend yield and 21 PE is, I would say, closer to the bottom in terms of valuation. But the analogy there would be look at how this has deflated relative to consumer companies. So the consumer staple companies have similar growth rates, but their valuations are probably twice or more than the IT companies. In fact, I would say the second pocket, which is the consumer staples, are probably something that could be derated, over the longer run, if though that is the kind of trajectory that they see. But as far as IT is concerned, I think the large caps are already reflecting the deflated valuations.
Okay. That's, how some of these larger sectors are shaping up. So, talking about the strategy from here on, in terms of preferred sectors, preferred, bigger bets that you would take, where you deploy additional money, Rajesh, where would it go? Because even for financials, I mean, now with Axis Bank, everything's become a bit of an issue. And we're seeing that reflect in banking stocks today.
So you have to widen your gaze. I think it was fairly expected that the first half is, you look at GST collections, you look at auto numbers, you look at credit growth. Not surprising that the results are weak. I think the results for the first 2 quarters are expected to be weak. But look at the RBI stimulus, right? How determined RBI is to get growth back on track. So my sense is that the 100 basis point decrease in interest rates will spur growth in the second half of the year, and therefore, there should be an expectation that earnings will for 26 second half and 27 will accelerate from the current levels that you have. So to be expected that the first half will be disappointing, but I would say elongate that gaze, and I think you'll probably find that there is room for optimism. And therefore, my sense is the downside to this market is going to be relatively low. But given the absence of triggers on earnings, it is going to be a bit of a range-bound market.
Okay, Rajesh, thank you for joining us. Range-bound market, that's the verdict coming in from you. Appreciate you joining us as always here on CNBC-TV18.